Financial markets have been playing something of a guessing game of late over when the major central banks will begin to cut interest rates and how far they will fall in the year ahead. But there's been far less discussion about where interest rates will end up, the so-called terminal rate debate. Yet this is a crucial decision for long-term investment plans, directly affecting the outlook for bonds and indirectly affecting equities. Now, the Federal Reserve in the United States, they give us a clear idea of their thinking on this issue with their long-term dot plot for the federal funds rate. And the median number that they come up with is 2.5%. By contrast, market pricing for US interest rates in the longer term, well, that shows much higher values. For example, the futures market for federal funds rate itself, that troughs out at about 3.5% in the longer term, a full percentage point above the Federal Reserve's own estimate. Now, part of the difference admittedly does relate to the median versus the mean for the dot plot. The average of projections above the median exceeds that for those below, but a wide gap remains. Moreover, when it comes to the near term, we see the opposite pattern, and the Federal Reserve have consistently pushed back on market pricing, which is for cuts that are bigger in 2024 and come earlier than they, the Federal Reserve themselves, think are likely. Now, there's an old saying in the markets, don't fight the Fed. And in this context, the advice would be patience in the near term, but optimism in the longer term. And indeed, if the Federal Reserve are right about the ultimate destination for the federal funds rate, that would make bonds attractive and equities would be supported in the longer term. Well, what can we say about the equivalent interest rates in the UK and Europe? Well, looking at interest rate futures, they point to a terminal rate of a little over 2% in the Eurozone, but getting on for 4% here in the UK. Now, that former number just seems too low, and the latter number too high, as far as I'm concerned. And one way of looking at this is to consider the chances of reality turning out by, say, 1 percentage point different from these numbers. Now, 1% just looks implausibly low for the Eurozone, and 3% entirely possible. By contrast, with a 2% inflation target, sustained UK interest rates of 5%, well, they just seem too high, whereas 3% distinct possibility. And that suggests to us it makes longer-term bonds more attractive here in the UK than in Europe. I mean, other factors are relevant, of course, but these are quite a powerful implication. Now, the week ahead, we're going to get some crucial inflation data in the UK and the US, and there's going to be a lot of other important data out that will affect central bank decisions. And this will obviously dominate market attention this week. But in the longer term, the interest rate outlook will be less affected, and this, in our opinion, is a more powerful influence. Until next week, goodbye.